Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's program, I've got Adam Dawes of Shaw and Partners. I've asked him to pick the 5 stocks that he thinks look really good value right now. We're obviously in an unusual period for the stock market. You've got Donald Trump winning the US election. There's been a Trump rally. Questions around how long can this rally last for. We're expecting that Australia might cut interest rates in February. That would be a positive for the market, provided no surprise curveballs come as a consequence of the new president in the USA. So that's going to be the first part of the television program tonight. And my next guest is Angus Gluskie from a new LIC listed investment company called Whitefield Income Limited. The ticker code will be WHI. It debuts in December. It's an income fund. I'm going to talk to him about how they're going to invest, what is distinctive about what they're doing with their investment in income, and what's the track record like. What can we expect from a fund like this? So that's the show. Let's kick off now with Adam Dawes of Shaw and Partners. Thanks for joining us, Adam.
It's great to be here, Peter. Thanks so much.
All right, now we know that Donald Trump has changed the world as we know it.
Sure has.
He ultimately has an impact on how we invest. I've asked you to just tell us the 5 stocks that you like now. And you and I've been talking stocks for years, but
Yeah.
as things change, if China wants to stimulate big time, our reaction will be very different if they want to stimulate small time. And so,
Right.
and so along comes Trump. How are you thinking about investing right now?
Yeah, well, look, as you said, the world changed on a dime last Tuesday, and it wasn't because of the Melbourne Cup. It was because of what happened in the US elections Wednesday, our time as well. But following Trump's win, obviously markets initially reacted really well. Lots of optimism, sending the US equities higher, dollar higher, and treasury yields sharply higher as well. However, over the last sort of week or so, that Trump trade has lost a bit of momentum. And as investors reassess, I guess, the potential policy impacts. Now, a lot of that, while the US small caps have sort of outperformed, the European stocks have really dragged a little bit lower, and that's obviously due to tariffs that potentially is going to come through. And then we also saw the Fed Reserve and the English Bank of England cut their rates by 25 basis points as well to sort of potentially throw some more fuel onto the fire as well. But what I've done today is I've been asked for sort of 5 stocks that, with this Trump trade, with this Trump new world that's coming through, how and what is the new investment landscape? And if we've got some time, I've got some extra 2 ETFs for us to have a look at as well. Good. So a bit of a bonus for the listeners there. But look, what it is that what we're trying to do is look at where the revenue comes from. Now, we know a lot of Australian companies like WiseTech, CSL, BlueScope all come from that. They have a lot of revenue coming from the US. But what I've done as a marker, is basically that any company that gets more than 50% of its revenue from the US, there we go. There's our starting point for that. And then from there, we can continue to move forward. Now, the first one is Computershare. Now, that has already rallied. So I don't know if it's one that we could have a look at. It has just hit all-time highs the other day. So I think that one is sort of past its prime. But then Amcor and Aurora, both very big packaging businesses. Now, you might argue that some of those tariffs might negatively affect those businesses, but they do, especially Aurora has more than 50% of its revenue from the US. Now, getting into the sort of the healthcare stocks, Pro Medicus, PME, has done very, very well, and it's sitting on $200 at the moment, so it's been an absolute tear. But the one that hasn't really moved is PolyNovo, PNV. Now, PolyNovo makes the skin grafts for people that have got burns, as well as the dermal skin when you get a hernia or something like that your skin needs to repair. So that's quite an interesting one. There's a lot of activity in the stock, but not much has really happened at the moment. So that one is probably one to have a little bit of a look at. And the other one is TLX, which again, TLX is got a lot of its revenue, in fact, 95% of its revenue from the US, but looking for a NASDAQ listing and those kinds of things. So that should do well. And the other one is Reliance World is my sort of last one to look at. Reliance World, they're the ones that do the shark bite, plumbing, all of those kinds of things. So potentially households getting more, and James Hardy, that kind of thing, doing more in that space, I think will do very, very well. So yeah, there's a couple of stocks that have more than 50% of their revenue in the United States. And with the Trump-centric policy of bringing everything back into America, I think these guys are probably ones that you should look at inside the portfolio.
And I guess you would add this, that, okay, a lot of them have had strong gains.
Yes.
That was strong gains before the factoring in of lower taxes that Trump wants to introduce.
Yeah, good call.
Yeah, the interest rates are still going to fall until we get scared about tariffs and we start working out potential inflation effects. And really, the tariff changes might not come until the end of 2025. I'm sure he's going to use it as a bargaining tool with the EU and China in particular to say, all right, you know, I've got a mandate to do, so can you come to the party? And if you come to the party, I don't have to hit you with a 60% tariff.
Yeah, absolutely. And look, it could go up to 90% of something like China as well. That's been sort of what's been sort of touted around town as far as those tariffs. So yeah, it is a bit of a movable feast, and obviously every day we wake up is going to be something different, because I don't think that man over there can really sort of keep one line going forward. Obviously, resources are going to benefit from Trump. And I think that obviously the mining sector and the resource sector should do benefit from that, particularly oil and gas and uranium. Okay, they're the three sectors that I think should do well. And certainly we've been talking about uranium for a while. And I think gold's lost a little bit of its shine, but it should continue to do well no matter, I mean, I was going to say no matter who wins, but no matter if Trump is in the election or not. So I've got two ETFs. Do we have time, Peter? Just two ETFs?
Go to ETFs. People like ETFs.
Yeah, so they're two ones from Global X, so they're sort of the same provider, but one is PAVE, PAVE, and that's a US infrastructure development ETF. So infrastructure, we know infrastructure is sadly lacking in the US, and that's something that you could definitely have a look at. And it's got some multiple midterm and short-term catalysts, obviously, with the money that's going to be going back in there. So that's PAVE. And then the other one is defense. I think defense, but the stock code is DTEC. D for dog, T for Tom, E for Echo, C for Charlie, DTC. That has got some really, really good stocks in there as far as Lockheed Martin, Northrop, General Dynamics, Palantir, BAE Systems, the list goes on. And so I think that one where you will see a massive amount of money going into defense, and basically that thing is just going to keep going for a couple of years. So there's two extra ETFs for all of those people playing at home, and I think there's some really good ones there to have a look at to bolster the portfolio.
I wonder if PAVE will have a bit of a contribution to building that wall between the USA and Mexico. Hasn't been quite completed at this point in time.
Maybe. You never know. You never know.
Adam Dawes, thanks for joining us, mate.
Thank you. It's great to be here.
And that was Adam Dawes of Shaw & Partners. My next guest is Angus Gluskie from Whitefield Income Limited, or WHI. Welcome to the program, Angus.
Pleasure, Peter.
So we're talking about an income fund, which is going to be listed on the stock market. When does it list?
So early December.
Early December. It's called the Whitefield Income Limited.
Correct.
Fund?
Correct. Well, just Whitefield Income Limited.
Okay.
Short.
All right. Keep it short.
Yeah.
And so tell us, what's the core driving investment theme so you deliver good income over time? Because that's why people will invest in it. If they can believe you can do it, they'll do it. They'll invest.
Yeah, so it runs an Australian equity income strategy, and by that we're meaning it holds a portfolio of Australian shares that are actively managed. So it's changing all the time.
Yep.
When it invests in those shares, it's looking to invest over the most productive parts of companies' income generation, recognition, and dividend payment cycles. So by that we mean it's earning income as companies generate and have the income recognized in their share prices, but it receives its income as franked dividends from the companies in which it's invested.
Yep.
That gives it a high level of dividend income, which in turn it's able to pay out to its own investors as monthly franked dividends itself.
So how many stocks do you think you'll be holding on average?
Yeah, so we hold 70 to 100 stocks in the portfolio at all times. And a big part of what we're aiming for is diversity. It's a very good way of ensuring that you've got adequate levels of risk control.
Okay. Let's do some history here, because some people might think you're a Johnny come lately, you know, all of a sudden joining the income fund fraternity. But Whitefield Industrials has been around for a long time.
Yeah, so Whitefield Industrials, as compared to Whitefield Income, was founded, back in 1923. So, you know, almost a parallel universe there, 101 years ago.
Pre-depression.
Pre-depression, that was a bold time to start one, and we're back again doing it 101, 2 years later.
Yeah, let's hope there's no depression following this
no,
one,
we don't
mate.
want that parallel.
No, we don't want that parallel. And so it is you're telling me before the interview, it's the oldest listed investment company, LIC, on the Australian Stock Exchange.
Look, that only early 1920s, the concept of public investment funds really wasn't out there. So our earlier version was that they were innovators and they created a fund, and it gave people a good avenue to invest and get synergies from pooling their investment, lowering costs, and still accessing interesting assets.
So, and it's still around today.
Still around today, going strong.
Yeah. Jeff Wilson hasn't tried to take it over or anything?
No. I think Christopher Skase might have had a go back in the
Did he really?
day.
Okay. All right. So this fund has had how many years of experience before you brought it to market?
Okay, so we've run the strategy in an unlisted fund format for just under 4 years now.
Yeah. Okay. And what kind of performance have you registered? I expect it's going to be good. Otherwise, why would you try and take this to the public?
Yeah, look, this strategy, because it's looking for something, it's always searching for something different. It's looking to get a benefit relative to its benchmark index, which is the ASX 300 equal weighted index. And that unlisted fund has generated around 4% excess returns, so returns above its benchmark across that time frame per annum.
Yeah.
And that's after reduction for the expected costs of operation of Whitefield Income Limited in its listed structure.
What's the history of capital growth? Like your main game is income, but you do pick up capital.
Well, it's given that we're generating a lot of the return as income and looking to pay that out to investors. This will be a fund that largely distributes over time its entire return. We don't want to erode the capital value, so we'll be aiming to keep the capital value either steady or allow a small level of growth over time, but majority out as distributions.
And for those people who don't understand how a LIC operates, a lot of people I think have got used to exchange traded funds, people who weren't used to funds. Explain how the return will come, because some people would think, oh well, it's like a term deposit, but it's not.
Yeah,
we know that you can't guarantee capital return, though of course you're working on that you can maintain your capital. So how does someone get their return?
Okay, well, one of the beauties, and this fund suits the listed investment company structure well. We intend to cap the structure over time, and of course, one of the characteristics or differences of a listed investment company is the fact that it has a fixed capital once it's issued capital. So assuming that this fund is ultimately capped, because it operates best at a limited size, it will suit that fixed structure. But also one of the benefits of that listed investment company structure is, unlike an open-ended fund or ETF, we don't have to pay out all of our income and gains within a 12-month, within the year. So we're able to retain income or gains in particular, and that just allows us to smooth the income and pay a more consistent stream of dividends to our investors. So that's where some of the difference occurs. So for investors, it will mean we still have a net asset value, and the net asset value will fluctuate based on the the actual value of the underlying investments. And given that they're Australian shares, people should expect it to have some variability. But beneath the surface there, the product will be generating income from its dividend earnings, and that should be that will be going on month to month, week to week, and we'll be distributing that out as monthly franked dividends to investors.
Okay, so it's monthly, it's franked, it's dividends. Will you be only investing in companies that pay tax in Australia and therefore frank dividends, or will you occasionally go into, say, REITs, which can be pretty good for income?
Yeah, we actually invest in both, and it's a point of difference for this fund compared to some of the others in the market. So the particular pricing anomalies that we're chasing or targeting are evident both in franked dividend paying companies as well as unfranked or entities paying unfranked distributions. So look, we target both. We see both as being in our opportunity set.
4 years ago, you started this fund. I'm aware of why you might have done that. Term deposits were paying about 1% if you're lucky.
Yeah.
Did you get a lot of interest because of that, that term deposits were so low, and a lot of retirees chase income?
Look, I guess the fact that interest rates were low and people were looking for sources of income was certainly in our mind. But we've actually only run this on while it's been an unlisted fund, it's been on a closed seed basis only. We haven't opened it up to the public.
Okay.
This is the first opening. But it was an interesting time to start one because we were in the years where, the post-COVID years where companies were actually cutting their dividends as well. So it was a very good test of this strategy. And what we realized, both from that period where we run it, but also through our back testing over many other economic environments, the strategy inherently has a quality-esque or defensive tilt to it. But the reason that it's always looking to invest in companies that are profitable, dividend paying, cash flow positive companies. And so it has this nice trait that over different years, different economic conditions, the strategy orients itself to those businesses and sectors of the Australian economy that are doing well in the economic conditions of the time.
Okay. But this whole interview is quite challenging for me because I have the Switzer Dividend Growth Fund, which of course it will be ultimately a rival of yours. But as I say to even our financial planning clients, that I believe people should have a variety of income funds. Just we don't always get them right, and I'm even happy to say Vanguard's high yield fund's been a pretty good performer as well. But most people who talk to me look for these sorts of funds that we're talking about to coming around 4 or 5% plus franking credits. Do you think you'll do well on that kind of comparison?
Yes, look, we expect to set the initial dividend rate here at 5.6% before franking credits. That grosses up to around 8%, inclusive of franking credits. We know that's roughly the sustainable base level of income that the fund can operate to, or actually it's probably a conservative view of that, but that underlying income. And look, the total return that the fund will generate is going to be a byproduct also of equity markets generally. This is a fund that when equity markets go well, you still get the benefit of that upside. So, for example, last year was a cracking year for Australian equities, and in the year to 30th of September, this unlisted fund after expenses produced a return of just over 22%. So, you're not trading off your upside.
No, that's right.
So
I guess there's one thing I learned, or one concern I learned about LICs is that sometimes you can have a really good fund, but the market just doesn't value your quality. And so your NTA is up here and the market's saying, oh, that's all we want to pay for it. How do you think you're going to deal with that kind of thing?
Well, look, what we can see is that there's good demand for this type of product in the market. Our nearest competitor is trading at premiums, which tells us there's just good underlying demand for a well-run income strategy. But in addition, look, I'm a big believer that LICs are very good structures, but it's really important that they're run in the right way. I think some of the basics there are don't overissue capital. And this fund, which we intend to ultimately cap, it's not going to be a fund that that has an overissuance of capital. I also think LICs need to be somewhat flexible while they've got a structured capital. In the event that demand and supply mismatch and some investors need to get out, then I think it's important that the LIC recognises it. And if needed, if there is a genuine persistent mismatch, consider avenues such as buybacks, which just allow some investors to leave, but leave the remaining investors in there. That's a good solution.
Yeah. It's the opposite of dilution, isn't it?
Yeah.
Exactly right.
So,
Mate, congratulations. Hope it works out well for you. Not too well, but it's a good offering. I think the market always wants to. Well, there's a lot of people in the market that wants income, and I think you guys are obviously going to produce that kind of thing.
Yeah, well, sure. We're big believers in the strategy. Look, we're planning to be investors too. We invest alongside our external shareholders, and again, good alignment of interest. And let's hope it goes favourably.
Great stuff. Well, that's Angus Glusky from a new LIC called Whitefield Income Limited. And that was Angus Glusky from Whitefield Income Limited. That's the show for this week. Thanks for joining us. Next week, I'll be focusing on what could go wrong with the Trump rally. And if that's the case, what should we be investing in? What should we be buying? And what should we be selling? That's next week. And don't forget, if you want to become a subscriber to the Switzer Report, go to theswitzerreport.com.au. Once again, thanks for joining us. I'll see you next week.